Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of US rate strategy, and Theo Chapsalis, head of UK rate strategy. Everyone, welcome back to another Bondcast. I think I say this every week, but another busy week. This week, Europe's taken centre stage. We've had a dovish ECB meeting, which is driving markets today, which is Thursday, although I'm sure it won't be when you're listening to this. But before we get stuck into the ECB, Blake, perhaps you can just update us on your latest thoughts in the US.
Yeah, sure. I think this week has really been, I'd say, about three themes, kind of trickling around markets. The first being extension of some relief that banks got around the time of the crisis last year from some of the leverage ratios and constraints on their on bank leverage that were given back around the time of the COVID outbreak. Those are set to expire at the end of March. So there's been a lot of focus on whether those are going to be extended. There's several regulators involved in this. It's the Fed, the FDIC, OCC, all bank regulators in the U.S. They've kind of done this in partnership, but most of the focus this week has been on whether or not the Fed's going to specifically extend it, with an assumption, I think, that the other two agencies largely follow the Fed's lead, I suppose. The second big theme this week has been supply. We have 10s and 30s this week. We also had 3s, much less of a focus, given that it's really about the long end and whether or not demand for the long end can keep up with just the steady drumbeat of supply that we've had over the last year and is going to continue for the next year. I think yesterday's 10-year, we're still waiting at the time of this recording on the 30-year results, but yesterday's 10-year auction was a bit Goldilocks. It didn't really give that sign one way or the other. I think people were coming into it thinking, okay, we either get a disaster of an auction, much like the 7-year that we had several weeks ago, that's going to give us a clear sign that kind of clear the path for another leg higher in the sell-off, or it's going to be a very strong auction and kind of validate a little bit of the stabilization that we've seen over the last week. We have kind of traded relatively within a range over the last 4 or 5 sessions. So I think if we would have had a really strong auction, it would have kind of justified that and told the market, hey, we're seeing some signs of stabilization here. Maybe we're in for a more range-bound trading rather than this steady march higher in yields that we've seen for the last few months. I don't think it really gave a signal one way or the other. It was a little bit below expectations. Shouldn't say expectations. It was a little bit below what you would expect for a strong auction. The dealer takedown was a little high, which means that the buy side didn't have a lot of demand for it. It did have a decent tail, which is just means we didn't quite see as strong a demand at the auction as people were expecting. But it wasn't terrible. It was bad, but I think given a lot of the circumstances around it and the really bad, the expectations for a really bad auction, it didn't really deliver on that. So I think everybody's kind of turned to the 30-year supply for maybe that signal they were hoping for. Last is just talk about next week's Fed meeting. I think most of that centers around how they're going to respond to financial conditions. I think we're going to come back to that a little bit later. Also, this SLR decision, I don't think it necessarily has to happen at a Fed meeting. But I think just with the Fed meeting on tap next week, a lot of people are wondering if they're going to say something about this SLR exemption at the meeting. Third is the dots. I think we were very close to seeing the median increase for the 2023 dot to start showing a hike in 2023. And if we see some members kind of acknowledge the improvement in the economic outlook and those dots actually start to move up, we get the median starting to show a hike. I think that would be taken as a relatively hawkish signal by the market. So that is also something that I think is very much in focus. Lastly, I would just say this IOER overnight RP, the Fed's main policy tools for controlling rates at the very front end of the curve. There'd been some speculation that they might increase those. A lot of that has died down. Front end rates really didn't fall as much as people had been expecting. So I think that's kind of come off the table. And the focus on them doing something about that at this meeting has really tapered off. So that's kind of what we're talking about this week in the US.
Thanks, Blake. Sounds like it's a busy week there too. So over to you, Theo, in the UK. I know there's also a Bank of England meeting there next week. We get the, if I'm not wrong, the supply calendar this week as well. We're recording this just before it comes out, although I think it'll be published afterwards, so just to caveat with that. But and I also think last week we haven't spoken since you officially updated your call on 10-year gilts to 1%. So perhaps you could just give us your latest views in the UK with everything that's going on.
Sure. Thanks, Imogen. So first of all, we start with the fundamentals for UK rates, and the bearish narrative remains intact. When we go and look at the reasons that drove the sell-off, well, they are still here. We talk about a market where issuance and actually the magnitude of net supply will be higher than what it was before. Even though the outright number of gross supply is lower, the net number will be higher. We talk about a market where inflation will be on the rise. We talk about a market where we had a sell-off, and the Bank of England, they have been not troubled. They didn't have any objections with regards to the sell-off. At the same time, as you've mentioned, we are having tomorrow morning the issuance calendar, and then next week we have the BoE meeting. It's the main theme of that meeting will be the timing of the tapering of asset purchase. So there are two major options. We think that there are significant chances that a reduction in the pace is announced at the March meeting. The majority of investors think that that reduction in the pace will happen at the May meeting. Depending on how this is communicated, we talk about a potential sell-off for the market, especially if it does not come with some sort of verbal support from the Bank of England to cap any disorderly rise in financial conditions. So looking forward to the meeting, we do expect tactical players to be short the market. And as you've mentioned, indeed, we have moved our target to 1%. And we think that this is probably, a level where the fundamentals and that additional supply will find quality investors.
Great, thanks, Theo. So Giles, over to Europe then. The key event this week has been Thursday's ECB meeting. We were expecting a kind of repeat of recent rhetoric that we've heard, that they will lean against rise in real rates. Actually, what we got was a more explicit commitment to that in terms of ramping up purchases over the next few weeks or the next quarter even. What are your kind of key takeaways from today's meeting?
Well, first of all, I'm kind of annoyed with them, I have to admit. I think, it wasn't entirely a surprise. And obviously, it was a very, very closely watched meeting for exactly the reason that became obvious with the announcement, right? We were looking for this kind of thing, but as you say, it was a little bit of a surprise. I think we've learned something about the way that they do things, which is a little bit different. I mean, I think we had in mind that they were flexible in their purchases, and and that probably should. I guess most people probably, like us, had in mind that meant that they could vary their purchases week to week, and the fact that they hadn't done so over the last few weeks just suggested that perhaps they were willing to just kind of stand back and let the market sort of find a level. But it turns out, actually, what they were doing is that they just wanted to have a proper opportunity to really discuss it in the context of their quarterly forecasting round and so on and so on. So, overall, it's a surprise, but as I say, I don't think to any observer really a massive surprise. But it does change our outlook on markets. I mean, we have been bearish for quite a while, for all of the reasons that we've been repeating on this Bondcast again and again, and for reasons which, frankly, in my opinion, continue to apply, at least in other jurisdictions. But when you have a central bank that wants to lean against the market move, I think it's a very difficult thing to take them on, to be honest with you. And we've been debating a little bit since the meeting amongst ourselves, exactly what is this, what does significant actually mean when it comes to purchases? And how much are they actually going to increase their weekly or their monthly flows, or however it is that you look at this? And yeah, I mean, I'll give you a number. We base case think it probably means around 20 billion. I mean, that was something that came up in the press conference, and obviously Christine Lagarde ducked that one. I mean, there's no real chance that she was likely to be cornered by a question like that. It could be more, could be less. I don't think it really matters that much. I mean, in the short term, if it were just that, you would say, yeah, no, you can always find an extra 20 billion of sellers. But the point is, that this is something that's going to be ongoing, and we've learned something here about the ECB's strategy overall. I mean, I know I was going to say reaction function, but I suppose it's sort of broader strategy about how it wants to deal with markets. And one of the first questions in the conference was spot on. Is this some a form of yield curve control? And of course, the official answer is no, but it's clearly a form of yield curve control. I mean, they're trying to dampen volatility, and while back in January they told us, and at the time it was a bit of a bearish signal. They told us that they weren't going to squeeze the market by blindly seeing through a sort of quota for their PEP purchases. And now they tell us, okay, flexibility is two-way. We'll also increase in order to contain yield levels. And so, where are we left? We're probably looking for slightly higher bunds in the short term, to be quite honest.
That makes sense. What about periphery as well? BTPs have tightened sort of 6 basis points now on the day since the meeting. What's your take there? Is that right? Should they be tightening more?
I mean, it's clearly an unambiguous positive for periphery. I mean, the lower yield levels are good for periphery, and it's both good for debt sustainability. It's good for investor sort of yield reach, that kind of activity, and it's I suppose just the force of flows as well. The additional ECB buying, which will be directed towards periphery, will also be supportive there. I would expect this will continue.
That makes sense. Thanks, Giles. So I guess the question really now, looking at this on a global perspective, we've had a dovish ECB who are being much more, or who had already been more aggressive than other central banks, but who now clearly have been explicitly more aggressive than certainly the Fed and the Bank of England in the action that they're going to take to kind of fight these rising real rates, at least. So looking ahead to the meetings that we have next week, we have a Fed meeting and a Bank of England meeting. Does today's more dovish ECB change what we're thinking about the reaction function of the Fed and the Bank of England next week? Theo, do you want to start there, and then we'll move to Blake?
Yeah, absolutely. I think it's interesting because also the UK is we've left the European Union, but we're still close to Europe. And to a large extent, investors trade gilts versus bonds, and they look at the market, they look at the two, and they draw their conclusions. So I think that the BoE in this regard is in a totally different place than the ECB. The BoE hasn't opposed the move up in yields. The BoE will have to consider when to slow down the amount of purchases. So when we look at the numbers and when we look at the data in the UK, they look fairly strong. So we have members that actually are concerned of upside inflation risks, not downside inflation risks. Andy Haldane has mentioned that this is a tiger that we have unleashed, and we need to be careful how to deal with a tiger of inflation. So clearly there are concerns of higher inflation in the UK. We expect, because of that, a different stance. We expect to hear about a normalization of the level of yields. We expect to hear about a rebalancing of flows out of fixed income into other assets. So we expect to hear very, very different BoE to what it has been the case from the ECB. For me, one key part and one key factor that makes the UK so different from the euro area, but also from the US, is our ability to meet the inflation target. And when I compare the UK to other jurisdictions, the UK did not really have ever a serious downside inflation problem. And you have the euro area, obviously, and the US that, well, they speak for themselves. They've got a different case. So that's the case for the UK.
Yeah, it's certainly a different case here in Europe. Blake, what about in the US? What do you think this changes Powell's reaction function next week, or is his message still the same, do you think?
Well, I think we already got the change. We had comments from Powell and Brainerd and a few others in kind of the week before they went into the blackout, and we saw a very subtle shift in the way they're talking about financial conditions and kind of the rise in yields. Very, very subtle. I mean, it was not a big step, but I think they've kind of chosen that language, and that language, in my mind, is probably going to be the one, the lines that are repeated around, either the statement or in the press conference this week. And that was really this focus on kind of two things. One was, and I separate these out. One is kind of the market functioning aspect. So we have these kind of, potential liquidity issues, disorderly kind of trading conditions. That's one thing they're worried about. You heard both Brainerd and Powell kind of talk about the speed of the moves and concerns if there were quote unquote disorderly conditions in markets. Then there's kind of a second aspect of it, which is what they called a persistent tightening in financial conditions that they would be worried about. That really speaks more, not so much about market functioning, but really more towards the dual mandate growth outlook, et cetera. Would probably be something they would respond to with a more kind of durable change to the asset purchase program. That's not something I think they're even close to considering. I think they probably repeat that language about persistent tightening, and I think I wrote this in one of our pieces last week, but I think persistent tightening in financial conditions becomes the new substantial improvement language, where everybody kind of wants a metric, or they want the Fed to kind of commit to some yield level or something that they're looking at that we can measure and see how close we are. But I just don't think they're going to give that. And I think all they're going to say about it is that we're still far away from that point. And I don't really think they take any steps other than to acknowledge that, to really push back against the rise in yields. They maintain that this has all been for good reasons. It's improvement in, the improvement in the outlook around vaccinations, around, how much scarring we saw from the last surge in December. The fiscal outlook, all these things have been really driving the increase in yields in their mind. And I think a lot of times markets, we tend to look at intraday charts, weekly charts, and everybody got kind of real panicked in the last few weeks because we, have a couple sessions of real yields going up. We see, very kind of short-term tightening in financial conditions and really start to panic. And I think the Fed really is looking at months-long, if not quarters or years-long charts and saying, hey, look, we're still very, very accommodative. There's really no reason at this point that we need to get involved and to take a stronger hand against against rising yields.
Okay, so Giles, with three, but I guess the ECB, if we think of the ECB as one and the Fed and the BoE as other, with two quite opposing central bank strategies, and that really being, I guess, this central bank reaction function has been the kind of theme of markets over the past few weeks, and us saying in Europe we don't want to fight the ECB and that kind of shifting our near-term view for bonds. Where does that leave us, I guess, on a cross-market basis for Europe versus the UK and the US?
I think that the obvious answer here is probably the right one, that we're looking for some outperformance of European fixed income in the short term. Now, I suppose that this kind of growth and vaccinations or progress differential seems to be a theme that markets want to go with. I personally have issues with it, and I think that actually, when it comes to opening up, we won't see all that much difference in terms of timeline, but it doesn't seem that the belief is necessarily growing particularly quickly in markets. So maybe just one to monitor. But where I do think that there's a clear difference is obviously on the fiscal side, and so that's something that you can definitely play. And I think that once you've got the central banks going in the same direction here. So the ECB going, no, we're going to resist this because we think that rising rates are it's about sympathy with global rates and so on. It's not really European fundamentals. It's something we're going to push back on, but you don't have that in other areas. I think it's a very difficult theme to oppose. So I guess that's the way I'm thinking about it short term. Longer term, though, I mean, I do think that there's still going, a catch-up story to happen, and obviously we'll be monitoring closely to try and figure out how to time that. So listen to future Bondcasts for our views about how that's how that one's developing. And as before, I can think of lots and lots of reasons which go well beyond a single piece of I guess information about the ECB strategy for rates to move higher. So so I guess that sums it up really.
Nice, thank you. Well, it seems like a nice note to leave it on there. Lots to watch next week. I'm sure we'll be back discussing the Bank of England and the Fed and anything else that happens between now and then. So thank you all for joining me again today, and we'll catch up next week. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.